Everyone, I'm Kevin Krieger. I am our instructor here for FIN 6406, which is graduate level financial management. And say for some of you, this will be a lot of stuff that you've seen before with some new pieces, wrinkles, and twists. For others of you, this is a large new subject of a lot of kind of wild stuff. And my goal is to try here in these presentations is to try to smooth over some of the most important points, to try to add some insight, and to be frank with you, to try to give you a distilled version of things with with say some expertise, hopefully, beyond the textbook, which is to say, highlighting the portions that matter the most and drawing some examples that are most relevant from them, and also practically speaking, in terms of succeeding in this class grade wise, to give you some hints, some ideas, some insight about what's likely to come up again for points for graded material and stuff like that. So as we say, it's syllabus and such. Part of the your job here, especially in a graduate class, is to read your textbook and such. But I'm not so naive as to think that with all of this amount of material to cover, that people are super diligent about always doing that. Well, I want you to, and that's the way to get the full information, the most bang out of the class for your experience and such. But I think it's a huge amount of information that we cover, which is typical for a graduate managerial finance class. No matter where you take it, you're going to cover a huge amount of material. It just goes with the territory. But I do want to try to give you some prioritization, some help with the most key points, and again, in terms of your grade and such in the class, some insight about where your emphasis might tend to lie. Right, so we're going to talk about some of the, here you get some outline type ideas here about what finance is and such like that. This is an introductory type chapter, so I don't really envision much in terms of number crunching here. I don't have any math, quote unquote, to do with you yet, but that day is coming for that sort of thing. So hold on to your hat for that. For some people are excited about that when it develops, other people more kind of timid and such, and we'll talk about those things together as the time comes, but we're mostly here setting the table for the overall class. And again, it's a lot of material, and that's just the nature of managerial finance. So that way, with whatever book you use, whatever instructor you have, I promise, whatever institution you're at. So I encourage you as we go through the class, whether it's these presentations or solutions that I share or that we have recordings for. Dr. Best has done a lot of recordings for practice problems and things like that. Whenever you come across something, let me know. Like, that's what I'm here to clarify, and I'm always just an email away. And if you'll let me know you're a student in our class and be as specific as you can about your question, and if you can show me where it comes from, if it's from a slide or a practice problem or whatever, just take a picture if so, and give me as much detail as possible, then that's my goal, is to help you further flush out things. So the goal of presentations and then your follow-up questions for presentations or practice problems is always to give you as efficient an insight as you can to the material with the knowledge from my end that there's a lot of it. Finance, application of economic principles and concepts to business decision making and problem solving. Fair. To me, it's a combination of economics, which is really an ancient field of study, and accounting, bookkeeping, which field of study, or well, I'm not sure, but there's been bookkeeping practices for thousands of years as well, and also a bit of psychology, especially in modern day academic finance. So if you've never taken an academic class before with an FIN prefix, a true college finance class, well, welcome. And what you're really looking at is an intersection of economics, of psychology, of accounting. You'll see how those things kind of work together. Now, in our class, we have what's known as a managerial finance or a corporate finance class. If you saw a book or something or a class at a different institution that was called corporate finance, um, or managerial finance, or management of the firm. They're all the same thing. And they're specifically talking about looking at finance from a corporation's eyes. A corporation, it's important to know how firms, big ones, corporations, how they think, what they value, what they're motivated by, the sorts of tools they have at their disposal, and when they employ them, and that sort of thing. So that's our overall kind of mission here. There's other types of finance classes too. A lot of people, when they think finance, even as an academic field of study, they think about, well, valuing, should I buy AT&T and sell Microsoft, or buy Coke and sell US Steel, or blah 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 blah. That's an academic area too, but that's more what we think of in school as a investment finance type of class. You're in a corporate or managerial type of finance class here with me, and there is some overlap. But the real reason that a class like this tends to be mandatory in a program, whether it's an undergrad version of managerial finance or a graduate version for whatever program you're in, is because if you're a business major of some kind, you need to know how corporations think, what they find important, what tools they have, what they're motivated by, who runs them, who makes the decisions, all those sorts of things. That's something that everyone needs to know as a business major, because even if you don't work for corporations, you're certainly going to work with them throughout your career, whether they're your customers, your vendors, et cetera, et cetera. So that's why this is mandatory type stuff for everybody. Investment finance tends to be more of an elective sort of thing, where those who are interested in things like buying Coke and selling Pepsi have their day, but that's not necessarily something of interest in a more general business context. Hence the reason that it falls where it does in the curriculum at kind of like the general level. I should have turned the page already, but right there you go. In particular, we kind of try to have an eye on the best decisions that corporations can make. And when I say the best decisions, you have to know what the tools are out there. Should we issue stock? Right? Should we issue bonds? Right? Should we take on this new venture, or should we let it pass? Those kinds of things. So we need to introduce those sorts of tools here and talk about using them. And some of this I mentioned at the start will be review for some of you. For others of you, it'll be brand new. And so this is just sort of a general tip for the entirety of the course. As a graduate student in particular, you need to be self-aware. This is an enormous amount of material. Some of you, there's no way around just embracing a huge amount of work, right? Others of us, if you have some exposure to certain topics, you have an advantage where you might be able to just flip through some things faster. You have the ability in my graduate classes to not completely dictate your pace, but to have a lot of control over that sort of thing. And so, it's kind of up to you to manage those sorts of things accordingly. And so you got to just be honest with yourself, and you can always ask me a little bit more too about how you stand, and how to best use your limited time, because it's a large amount of material. This is a balance sheet. You've all presumably had at least a little bit of accounting, right? So you know that you have, right, your assets, right, that you're held on the traditional left-hand side of the balance sheet, and they're usually ordered in terms of liquidity, which means your cash and short-term, easily convertible to cash items would be higher on the asset side, right? And then your more fixed assets lower, right? And then on the right-hand side, right, again, order the debt and equity side of your balance sheet. You have kind of your current items first, and those are the things that are due quicker, and then long-term debt. These are both liabilities, right? And then your equity kind of in the bottom right, if you will. And of course, you know that means overall, all of your assets are backed by either liabilities or equities. So much so that assets equals liabilities plus equity. You want to be careful. One thing you want to always keep an eye on is that liabilities and debt, I even did it a moment ago, sometimes get used a little bit interchangeably loosely, and that's a little bit sloppy. A debt is one kind of liability, but not all liabilities are debt. Usually, when you use the word debt, you're talking about something that's interest bearing. So it's money that you owe, but it's also generating additional owing, additional interest. That's debt. You can have liabilities that, hey, I bought these supplies on credit and I just have an open, I just pay my vendors every 30 days or something like that, and they might not accrue liabilities at all. Or you have wages due to your employees, but you only have payroll every 2 weeks or every month or something like that. So anyway, not every liability is debt, whereas all debt are liabilities, and debt is specifically the interest bearing kind, right? So when you get into some questions, some thoughts, as you say, this is an intro type chapter, some thoughts about, all things that just come up here when you're considering the viewpoint of a corporation, right? What am I going to do? Like, what sort of assets am I going to avail myself to? Am I going to have more factories, right? Am I going to save money on fixed assets and have more of an online presence? And of course, these sorts of questions take on very different shines in different industries. There are certain things that can be done in kind of an exclusively informational way, especially in modern day. And then there's other things where you're always going to have a factory and that sort of thing. And of course, there's costs and commitments and things like that come with certain stationarity, and then there's stationality, and then there's other advantages to having that kind of foothold, that kind of presence. So those sorts of things are a topic of discussion. And then how are you going to pay for this thing? I mean, presumably at the very start, most businesses have some kind of startup capital from some kind of ownership. Now, whether that's immediately stockholders or whether there's a small business that starts in sort of a private fashion and then eventually grows to where it welcomes stockholders, but it just begins with kick-in money from the initial owners. Those are both somewhat common, and those are kinds of equity. And of course, there's also the option to run on credit or borrowing, right, liabilities. So there are pros and cons to this kind of thing, as you might imagine. We'll talk a lot about them throughout the course. Liabilities, of course, have you locked in, maybe even painted into a corner in certain cases where you owe money at certain times, right, in certain structures based on how you borrowed it, right? And then in other settings, right, you don't think the liabilities as a down thing. Liabilities might be a good thing, right? It might be cheaper for you to borrow money in some ways and in some fashions than it is to try to come up with equity with which to kickstart a firm and such. So there's choices about how to provide that kind of investment. That's actually a topic that we call capital structure in finance. It's something that we hit a full section on probably towards the end of the course, actually, about this decision between the two, right? And then you have to keep an eye on, well, even though you have an overall setup of the firm, right, where assets equal liability plus equity, you have kind of the additional concern that you have to always be ready for today, right? There are always bills to be paid. There's always, wages to employees. There's usually taxes that are due pretty regularly. You have liabilities that are somewhat fresh all the time, current liabilities. And so you need to have current assets with which to manage those. This is a liquidity type thing. Liquidity just means the ability to easily convert some sort of asset or liability to cash terms. And so managing that sort of cash piece of the puzzle, an operational question for kind of today and this week sort of thing, is an important consideration as well, because you might have a good business model with, right, a good product and good customers and good employees, but there is some management of the cash that has to be done well so that you don't run into any kind of short-term stalls and hiccups or even worse. I kind of think this, we have three main business types that the book talks about: sole proprietorship, partnership, and corporation. The big distinction, particularly for me, say some of my goal in presentations, is to let you know a bit of a shortcut about things that we emphasize in terms of what's most important and therefore most likely to be graded. quizzed on and concept checked on and tested on is what's different about corporations. Right? Small proprietorships and partnerships are, as kind of a group, the opposite, right, of a corporation. So when you look at the next few slides here, we kind of have this dichotomy, this setup where I say sole proprietorship on this slide, but as you see in the bottom, partnership is roughly the same thing, advantages and disadvantages, just a matter of whether you're talking about a single owner or multiple owners. But these are the things that kind of, at least for me, I just maybe colloquially I just call it small businesses, right? A small business. Now, you can have a partnerships that grows quite large, especially in areas like law or something where you have a really big firm with dozens or more of attorneys kind of thing, and that deals with hundreds of millions of dollars of revenue and such. But in general, it works the way you think it would, which is the convenience store owner or the dry cleaner or the sandwich shop owner tend to be sole proprietors. And then you have, when you think of the big names of corporations, whether it's IBM or Coke or same blue blood kind of stuff, right? That would be the opposite side of the coin. So when you look at slides 9 and 10 here, the advantages on slide 10 for corporations kind of match up with the disadvantages on slide 9, and vice versa. Here on slide 9, the advantages are kind of linked to the disadvantages on slide 10, right? Because when we say advantages and disadvantages, we're talking particularly relative to each other. So the good thing about being a small business, if you will, right, is, to be frank, the biggest one of all is that the tax burden is less, right? And of course, the disadvantage here on corporations is what we call double taxation. What that really gets around to, as you see in the book in more detail, is, when you have profit on a corporation, you pay corporate income tax on that profit. And then the owners at the personal level, the household level, like just think of me as a shareholder, if I get dividend income from your corporation, or if I eventually sell my shares for a capital gain, I owe personal income tax on that as well. So the same piece of profit, if you will, is taxed twice because of a corporation. Now, there's some upsides to the corporate ownership as well. A big one being that you have limited liability to what you do. If something goes wrong, right, with a corporate structure, and this, you can do this sort of thing to an extent with partnerships and limited liability structures and such too. But when you have a corporate structure, the corporation serves as its own entity, which could be sued and things like that. But it's not going to cost anybody directly their house. It's nothing going to be repossessed or have your own bank account levied if you haven't done anything like criminally wrong or personally negligent sort of thing in a civil setting. And then another big one with the advantages of the corporation is how easy it is to buy and sell. And this is really the lifeblood of even household retirement investment finance type stuff. Is, I'm no expert in shampoo or pharmaceuticals or Band-Aid, but I can own Johnson & Johnson stock, and they put out good products and they turn a profit and people buy the things, and just by owning the stock, I stand to get the dividends from Johnson & Johnson and share in their profits as they eventually selling my stock for a gain kind of thing. That's passive ownership. That's possible with a corporation. If I want to buy a piece of the dry cleaner down the street, that's very unlikely, right? That's kind of their lifeblood. It's what they do with their time. So, like, the corporate structure allows me to be a passive investor. This is what things like 401k accounts and IRAs and 403bs are all designed to do at that level. It allows me to be passive and still an owner. And I sort of end up paying for that, if it were, with this double taxation structure. I can sell my shares really quickly. That's easy transfer of ownership. The shares can live forever, at least in theory. If I have shares of Coca-Cola and I pass away, I can leave them to my heirs, that sort of thing. And it happens very easily. You can buy and sell shares of stocks really quickly. Really quickly. I can buy or sell a share within 30 seconds with my auto login to my accounts online kind of thing. That sort of thing doesn't happen with small businesses, of course. So pros and cons to this kind of thing, and it's a pretty obvious dichotomy to sort of set up. And if you want to see it in sort of a right side by side situation, now some of this is a little bit overdrawn. Like again, you can have some limited liability. You may have unlimited liability with general partners, but even then, there's some good attorney work that can keep that sort of thing low in like a doctor's office, for example. And while a partnership does indeed have limited life because the partners are the owners, indeed, family businesses all the time are sold to the children or willed to the children and things like that. So some of this is potentially a little bit extreme, but for the most part, it nails it. This comparison. Um, Again, I'm big into the ease, the liquidity of passive ownership. The ownership of shares of stock is a really powerful tool, especially for things like investment, right? Household investment, retirement accounts, and stuff. And that comes with the price. If you're not going to be the actual owner who operates the firm day to day, then it kind of comes with the price of double taxation. Sort of think of that sort of as a trade off. And so the big ones to me are the liquidity and ease transfer of ownership, but also the double taxation that comes with a corporation. Okay? This is kind of a hypothetical organization chart. If a corporation is its own entity, right, then who are the people that are in charge? The thing about this passive ownership structure that we talk about is that if I own the shares of Johnson & Johnson, but I'm no expert in shampoo, well, what do we do when it comes time to like make a decision on a new flavor or scent or whatever, or opening new factories, or well, I don't have any expertise. I don't want to make those decisions for Johnson & Johnson. I wouldn't do a good job. Neither would most of the other millions of shareholders of the corporation. So this passive structure allows a lot of opportunity as an investment, but somebody's got to run the show. Right? So this organization chart is really common when it comes to corporations. The board of directors is usually something like 10 or so individuals, might be 7 or 8, might be 15 or 17, usually 10 or 12 individuals that are elected by the shareholders to represent us. Right? Usually members on the board of directors are a few of the upper executives of the company. Those are called inside executives. Right? Chair, COO even might be on the board of directors itself. Right? And then there's a lot of outside directors who do not work for the corporation. Outside directors do not work full-time for the corporation. And usually the outside directors have the majority of the board, and they usually hold all the positions on like the auditing committee of a board of directors that oversees the financials and such of the company, so as to discourage any kind of like inside book cooking sort of thing. Not that it never happens, but that's sort of the idea. With only maybe 10 or so directors, you have a more manageable amount of people to make decisions, and usually the board of directors, again with the outsiders holding more sway, usually the board of directors it only considers really big picture type of stuff. Right? Again, most of the members don't work at the firm day to day, so they're not in a perfect position. They might spend a lot of time studying on their company and the needs of the stockholders and the possibilities of the firm, but they typically don't work there day to day except for these few insiders, and so they're not into the what kind of toilet paper we're putting in all of our store chains or anything like that. Usually they're big policy type of stuff. And then the absolute buck stops here person would be your CEO. Right? That's the highest officer who actually works day to day at the company, usually 50, 60, 80 hours a week sort of thing. They tend to be quite alpha personalities. The CEO is oftentimes the only direct employee of the board of directors, and the CEO then has a lot of authority on hiring and firing all of the management below that. Some companies have lots of levels of kind of upper and middle management, others less so. But you typically, with all corporations, have a board of directors with some insiders, some outsiders, usually more outsiders. The CEO, right, who is the number one employee of the company and usually a member of that board of directors, not always, but usually, and then some levels of middle management below, right? And those managers, especially the financial ones that we'll be emphasizing, our course is financial management, right? Are going to be the kind of the level of people that will be doing a lot of what we think about in this class. So when we talk about potentially issuing bonds, right, we'd be talking about financial managers at the corporation that are making the decision of when to do that, for how much, with what sorts of rates, for how long. When we talk about things like opening a new plant, and is it beneficial to do so? Do the financials make sense? We're again talking about a financial manager making those sorts of decisions, right? My second example there about opening new plants would be an example of looking for a value creating project. A project is kind of a general term for something you might do to increase your profitability, right? And then making smart financing decisions would be the best ways in which to do it. Do you do it by financing with bonds or stock? Do you do it with retained earnings? Do you have contracts you can use to potentially change your mind at later points? So all of those sorts of things are under the whim of the financial managers, which you're learning in this class a little more about how to be. Right? The traditional goal of a corporation, right, is creating wealth. The owners of the corporation are the stockholders, yes? They're represented by the board of directors. And why do they own the stock? They usually don't do it just for fun or for vanity or because they like looking at a stock certificate back in the day. They do it to make money. Stock, in particular, is an investment. It doesn't really have any utility other than the utility that it will go up in value and pay dividends. That's why people own it. So maximizing wealth, right, getting the most wealth they can out of their ownership is really the goal of what a corporation is all about. And that doesn't mean that you're always bloodthirsty and ruthless and looking to maximize value today. Sometimes you have more of a long-term focus. And there also can be sort of you can see things like corporate charitable giving and stuff like that too, that is not strictly maximizing wealth. So there are wrinkles and things, exceptions and stuff like that to it. But overall, that's what the owners want. They're the stockholders, and so that's what they're pushing the corporation to do, which means to up the price of the stock and or the dividends that it pays. Right. So to put it in short, right, the maximized goal, the benefit of the goal, because it's what the owners want and the owners own the shares, is called shareholder wealth maximization. And generally, again, that would be upping the stock price to allow you a capital gain if you want to sell, but also dividends are part of the puzzle of ownership too. We'll talk about some of the detail of dividends later, but there's a reason that corporations and the CEOs and the boards of directors care a lot about their stock prices. Right? Well, for one thing, they tend to own a lot of the shares themselves. They tend to be somewhat well off and wealthy and such like that. And also because they know it's how they're being evaluated by all of the stock owners out there. The people really want the price to go, right, as high as they can, right? And they want to get their dividends. That kind of thing is the whole reason they're investing in the first place. Now, I will say this. There has been some pushback on this idea. It's even been called, I think, once in Forbes magazine, but this goes back many, many years now. The idea that maximizing shareholder value is the world's dumbest idea. If you just Google the phrase world's dumbest idea, maximizing shareholder value, you'll see a lot of talk about this. And there are some exceptions. There are certainly things, again, you're not always ruthlessly pursuing the maximum value immediately, right? And a lot of the critique of shareholder value as the goal of a firm is kind of focused on, well, what does that really mean, kind of thing. But overall, it's the general idea that this is really important and that the reason really, that the owners own the shares is to get investment value from them is pretty undeniable. So you can quibble with it, and there's some counterpoints that I would encourage you to go look up, and if that's your sort of thing. But the general gist of shareholder wealth maximization is a pretty fair one, right? The interesting thing about a stock price, right, is where does it come from? Like, what's the idea of a stock price? Right? What does it actually take into account, as you see here? What do investors consider when analyzing a firm? The answer is everything, right? Now, some of you will not like my sports analogies, but I do these sometimes. Sorry, just a thing for me. Ultimately, if you're looking at a football game, it's not uncommon, deep dive in the statistics, and people want to. So let's compare the passing yards and the turnovers, right, and the yards per carry, and the third down conversion rates, and all this, that, and the other. But ultimately, what matters in the game is the score. And sometimes there's weird statistics that combine for a score, other times it's more predictable. But ultimately, the price of a stock is kind of like the score of the game. In one flash, it kind of tells you everything. Sometimes it's not so fair in football, I know, but if you only, it's supposed to take everything into account. It doesn't always do that perfectly in a ball game, I know, but so it factors in how profitable your firm has been. It factors in how profitable your firm is expected to be. It factors in how good the management of your firm is supposedly. It factors in how promising your industry looks to be in the future. Look out if you're against, in some have some sort of bad social cause or something to you that can be take your value down, whereas good profitability in the next year or two expected would take your value up. So all of these things combine together to form sort of a corporate value, if you will. I sometimes use the idea of intrinsic value when I'm doing these. Let's see here. Do my little whiteboard thing with y'all quick. Right, and the idea is the stock price. Sorry, need to get myself settled. Sorry. The stock price, right, should equal all the cash flows that a firm projects to make in the future. Right, so cash flow 1, cash flow 2, these are just periods in the future. But these cash flows in the future, they need to be discounted by today's value. So when you see these 1 plus I in the denominator, I is your interest rate as a decimal. So 6% means that I equals 0.06. This sort of thing. Right? So all the cash that a company projects to make in the future needs to be discounted, and it's 6% the first period, and then 6% squared the second period. We'll talk a lot more about this soon. And then the cash flows themselves. What makes your estimates of cash flows? Right? Well, some of it is things like, right? Some of it is things like how profitable you've been. Some of it is how many sales you project to do next year. Some of it is how good we think your management is. Right? So all those things come together to give you estimates of cash flows. But these are all just estimates. These are peeks ahead of what we expect or think is best going to happen, but they're estimates. And when it comes down to it, your price, you then have an intrinsic value. That's the name of the stock price that you estimate based on all of this future-looking analysis of a company. Right? So when you talk about the goal of a corporation and wanting to get the stock price up, what does that really mean? Well, it means you look to do things as a corporation that get your cash flows up, or that get your interest rates that you pay down, because either or both of those activities will increase the values of these pieces, and when you add them up, it increases the intrinsic value of your stock. So mathematically, that expression is your best model of what's going to happen, and it means that the goal of the company, right, is to get your expected cash flows up, your risk or the interest rates that go with them down, and if possible, because of the interest rate impact, you like to get more of the cash flows sooner and fewer of them later. Because when you go to total the value here, if more of the cash comes sooner, then it's not discounted as much. The rate by which you discount it is smaller, right? Mathematically, you divide by 1.06, right? It takes less of a bite out of the value than if you divide by, say, 1.06 cubed, that sort of thing. I'm kind of following up on that. The idea is, well, does that mean that my goal as a firm is to maximize profit? Right? And the answer is kind of. Now, say here no from the book. Now, generally speaking, right? Generally speaking, right? It's true that higher profit means higher cash flows. But ultimately, doesn't have to be true, right? So typically that's the case. But your value, your intrinsic value, is based on cash flows that you're expecting to make in the future. Because cash flows can be shared as dividends amongst the shareholders, right? Profit is nice, but until you release it to the shareholders for people to actually get, it doesn't have any value for you as a stockholder. It's nice to have, but it doesn't actually materialize until it becomes cash. Now, normally these things are linked. When you make more profit, you free up more cash, and that cash can more easily be paid off to the shareholders as dividends and things like that. So there's a high correlation between your earnings, right? We'll talk more about this soon, but EPS is earnings per share, right? And earnings per share, right, is the same thing. Your earnings, by the way, is your net income. This is more of an accounting thing now. Your net income. And the higher your net income, that's your profit or your earnings. Right? The more likely you are to have cash to disperse. But there are other things that matter too. Right? Sometimes having less net income today will allow you to make 5 or 10 or 20-fold more cash flow later. So it's not purely a matter of maximizing profits, right? But again, the cash flows will be better, generally speaking, when your net income, your profitability is higher. It is possible, of course, though, to have something that increases your earnings but gets your stock price to decline. Normally that would be something, again, like, hey, you might be able to up your earnings, but you're putting yourself at risk for future earnings. So you might up some cash flows today with your earnings, but it takes a bite out of the values of a big bite out of cash flows that might be coming in future years, sort of thing. So while the relationship is pretty good, it is not completely direct. Right? Agency relationships, just a few thoughts, because again, if you're going to have this structure of a company with a board of directors and then upper management, especially a CEO is kind of the first full-time employee of a company, and then layers of middle management and things like that, you're going to have some interesting things that come about. And this is inevitable, right? The passive ownership structure, I don't know if you have to write this down, but what the heck, right? The passive, right, ownership structure of a corporation, forgive my penmanship, that's why I don't do too much writing, right, kind of dictates some agency issues. You know what an agent means. You've had a real estate agent before, a lot of you, right? They work in your behalf. Well, I'm a Johnson & Johnson shareholder, but I don't have the expertise to actually run Johnson & Johnson, so I sit back and let my agents do it for me. And of course, when you do that, you've got human beings here. We've talked about psychology some. You've got human beings at work, and that makes for some interesting sorts of things, right? Okay. So, right, what happens if your managerial goals are slightly different than the shareholder goals? These are just some examples, but You might have situations where, hey, we could get some expensive artwork for the lobby at our corporate headquarters in New York. Right? Well, that doesn't benefit me much as a Johnson and Johnson shareholder, but especially if you're kind of careful and you're limited with doing anything too extreme or crazy, get away with a lot of that perk. I think that's a perk of the job sort of thing. Right? Sometimes agency type relationships or strange agency type relationships are survival based. And a lot of times, in the case of this upper executive and shareholder, upper executives might decide to do something that's too conservative. They don't want to take on much risk because the company's doing just fine and they want to survive. They like their high paying job and the perks that come with it, set expensive artwork and everything. Right? So that's a possibility too, where, hey, the shareholders would like you to be more aggressive in this case because, yeah, if it goes badly, then the company might even fold. But, I've got other investments in other companies and there's a real home run shot out here. Yeah, but if this is your only job and you're an upper manager, a CEO and stuff, you might feel differently about these things. So you might not always align, right, your goals as a shareholder with the upper manager. Another note here, it's somewhat common to think bigger is better. And the type of folks that tend to have upper management positions in a company usually like having a bigger market share, where they do a higher and higher percentage sales of the phones or of the software or of the soda, right? Or they like to have the highest or the most employees or something like that. That's not necessarily something that helps you increase your cash flows, though, right? In your back. What if you had the biggest revenues, but you also, sold your product 20% cheaper than you needed to? So you didn't make as much profit and therefore as much cash flow, right? So, yeah, sometimes growing a firm, oftentimes, is a good thing because with it comes economies of scale and things like that that allow you to, really press your advantage, but not always. Sometimes managers and upper managers, full-time workers at companies like them to get bigger, but bigger might actually hurt the value because it can make a corporation less responsive, more inefficient, right? You don't actually up the cash flows that every time that you grow in size, right? It's human nature, right? It's not always, it's not necessarily to think too badly of our upper managers, right? A lot of this is the same thing that most everybody would do in their positions. It's also normal then for the shareholders to be aware of this, kind of a cat and mouse sort of thing, and the shareholders then try to use some mechanisms to rein in that natural inclination to act in your own best interest. Things like, well, let's pay them based on stock price improvements since that's what we care about. Those are compensation type plans. And you hear about things like employee stock options and stuff like that. Right? Sometimes you can get extreme cases where the shareholders will do wild things like proxy fight for the company and oust the old board of directors, put in a new one, and thereby fire the CEO. That sort of stuff is relatively rare. Right? There's usually more carrots, things like nice compensation plans for good stock prices, than there are sticks. But the sticks can be real. The sticks can be real. That tends to happen, again, though, more in the movies than it does with real companies. Threat of takeover, that one actually probably happens more than the middle two bullet points. That's if you're kind of running things a bit lackadaisically, and an outside investor that has the capital to do so might decide to come in and try to buy out the company and or enough shares to take over enough board seats and thereby shake things up, sensing that, they're underperforming and I can do better. And of course, if those sort of things can get the managers to behave better and more towards the interest of the stockholder, typically maximizing the share price. Talked a little bit about painting oneself into the corner when one uses more liabilities. The nice thing about equity is the owners, right, if they put the money in and they're controlling more of the corporation effectively by their slice of the capital structure, then the owners can keep that eye on the prize of maximizing stock price. When you borrow more and you have more debt with your corporation, you're more likely to have to answer to your creditors, right? You even have contracts oftentimes with your creditors. Creditors are those, right, that you borrowed from, right? You're the debtor, you owe the debt, and they're your creditor, right? Well, if you have to answer to them, sometimes you even have a contract with them that you're not allowed to, pursue X, Y, and Z ventures until you um, have paid us back X amount or this and that. That's what I'm talking about, painting yourself into a corner, because the creditors don't want you to be too risky in many cases. They want to make sure that they're repaid first before you take on certain projects and stuff that might be a good idea, but might also go south on them. So that creates another kind of weird relationship where you have different stakeholders in the company with different opinions. Okay. We're going to say this has been a kind of an overall look. We're going to go really deep with this. This is graduate level corporate or managerial finance. And so I've got lots of material, lots of practice problems, lots of presentations, lots of sample things to try. But one thing I like to think about the course is, yes, I have an enormous amount of material for you to cover. We're doing lots of chapters, lots of presentations, but I've also got lots of tools for you, especially if you have an eye on your grade. You've got lots of opportunities to practice, to be ready, and to determine your own score and your own grade with work. Okay? We'll list a few things here again to sort of, these will be some things we'll be talking about in the upcoming chapters. Right? We're going to talk about trying to quantify risk and return, because you get the basic idea that, of course, you're only willing to take on more risk if there's more potential return for it. But to make that sort of thing come to life, we need to talk about measuring it. And in measuring it, we can better define why investors and corporations make the choices that they do, and what risks they will take on and which ones they won't, based on the kind of return that they do. Time value of money is a really important concept. And those of you that have had some finance, probably at the undergraduate level or in some of our prereq materials and that sort of thing, you will have an advantage here, because you have to be very time value of money competent to do well in managerial finance. It's kind of it's basically a necessary skill. If I tell you, hey, right, I have a $5,000 debt that I owe, but it's in 4 years, right? How much money do I have to set aside right now if it's going to grow at 6% a year so that I can make that payment in 4 years? Well, that's a time value of money type topic. It's just applying rates to interest rates in general, but we also have other names for them: costs of capital, costs of equity, required returns, things like that, right? Using or showing how, X amount today is worth X plus Y amount in the future, and or working backwards, and or implying the rate from knowing the two amounts, are all tools that you really have to be competent with to do well in the class. Right? We'll talk more about defining exactly what cash flows are. Right? And of course, to say cash flow isn't exactly the same as accounting profits. They're usually linked. The better your accounting profits, the higher your cash flows. Right? But you also say there's other things and considerations that need to be accounted for before that relationship is complete. When we talk about incremental cash flows, you're talking about particularly the idea incremental means an increment is an amount in addition to, right? It's the next step or the next piece. When we talk about incremental cash flows, we'll be talking about, hey, what does and doesn't matter in terms of adding cash flow to the firm. Like, some decisions do add incremental cash flow to the firm, and those are ones that we're going to want to spend a lot of time considering because they're the ones that matter. And other things are less important in terms of incremental cash flow. Okay. We've obviously talked some about maximizing shareholder wealth, but particularly in modern times, there's some understanding that not everything is about maximizing the share price immediately, as in today, as in, well, how many units can I pump out the door right now and take the profit, and I'm trying to hurry up and get the price as high as I can today before the clock stops. Right? Nowadays, we have more of a dynamic feel for these sorts of things, where typically being a good corporate citizen is actually going to pay off relatively well to you in the long term, right? So some other side thoughts to stockholder wealth maximization, right, includes things like being good to your customers, because even if you could squeeze them for extra profit or for extra revenue today, you might you might turn them off in the future. Right? You want to say you probably want to have an eye on um, efficiency, right? What else was I just thinking here? You want to have an eye on even your geographic needs if you're a corporate, if you're the kind of outfit that has more of a physical footprint, things like that. Right? All of those things, like said when we said earlier, that the stock price takes into account everything. We're not just talking about things that matter immediately today. We're trying to have a dynamic focus that takes on other things in the future. And then even if you're sort of cynical about societal firms and stuff, or societal concerns and things, um, you know, environmental impact, for example, and things like that, it's probably, even if you're cynical and eye rolling about things like that, it's probably somewhat wise to at least be careful about these kind of concerns, lest you turn off a lot of your potential customers about these sorts of things. So some of it might be genuine, like preference of the owners of the company, that yeah, we want to own a company that we're proud of. But there's a lot of conflict there. Different owners have different politics about different things, and the one thing they have in common is shareholder wealth maximization. They're investors to make money. So yeah, there's different politics amongst the owners, but at least having some cognizance of, you know, keeping society happy. I don't. Being apolitical is probably the best way in a lot of cases to do this sort of thing, right? Then it can be beneficial to be a good steward in that way, right? You're less likely to draw government ire, right, or more likely to draw government sort of benefit, nudge, that kind of thing, and you're more likely to have more happy customers, sort of thing. And again, I think threading the needle of um, some sort of politics and stuff like that is careful. We've had all sorts of accounting and ethical abuses from companies. It's been more than 10. This is an old version of the book. It's been more than 10 or 15 years since Enron. That's more like, early 2000s kind of thing now. But you still have corporate scandal, somewhat regularly. It's not always with corporations that you have financial ethical scandals, but just avoiding trouble is yet another reason. Again, avoiding the negative spotlight can be, even if you're just thinking of that cynically, is yet another reason to be careful about that sort of thing. There's been more and more kind of attempts to regulate, and then it deregulates. You can look at the life cycles of regulation for 100 years now. Had a big one in 2002 about accounting and such, and disclosures, but we've also had things about environmental impact. We've had things about what sorts of, or tax treatment of different capital gains and dividends and things like that. So there's always kind of new government and legal oversight of this sort of thing, and being kind of a good citizen, careful if only for self-preservation reasons, generally is a pretty good idea, because it keeps your nose clean and avoids some of the pushback that you get either from the government or the customers, or some combination thereof. We'll hit a lot of these topics in more detail. So again, please do not don't be shy if you want follow-up information about these things. My goal in presentations is to give you a little bit of feel for what we emphasize more when it comes to graded pieces, give you a little bit more insights about some things that I think are more important, and then leave off some things that I think are less important, because again, I know that you have hundreds of pages of textbook to cover if you just do the whole darn thing. And so please don't be shy.